Despite being immersed in illegalities, scandals, volatility, and lack of government control, cryptocurrencies are worth billions of dollars today. With over 18,000 digital currencies in existence, one is tempted to ask if crypto is really the future of money. Critics say it's a get-rich-quick or Ponzi scheme. How did it come this far? Is crypto the future or the world's greatest scam? Before you understand how cryptocurrencies penetrated the trading market effortlessly, it is pertinent to dig deep into their dark past. The Bitcoin we know today was the first ever cryptocurrency created. It was first mined in 2009 and remains the most popular and valuable digital currency in the world. This currency works on a blockchain-based decentralized digital currency powered by a network of users who can verify and record transactions without going through the bank. Bitcoin is an alternative to fiat currencies, like those used in your country: dollars, pounds, euros, name it. Transactions in the blockchain are verified through a process called the proof-of-work consensus mechanism. These transactions are completed by Bitcoin miners who solve complex mathematical functions using powerful computers. The rise of this digital currency also led to an increase in enthusiasts who were hopeful about its future. While some said it was a fun asset worth investing in, others believed it would soon become a dominant universal currency. In its first 13 years of existence, it was exposed to several highs and lows, but this was not enough to discourage people from seeing its worth. Bitcoin came into the financial scene hoping to fill the gap that fiat currencies did not. What do I mean? It's not a coincidence that the coin was invented during one of the most chaotic financial moments in US history. The global financial crisis of 2007 to 2009 was a wake-up call to investors who had their monies in the bank and trusted the system. The likes of Lehman Brothers filed for bankruptcy, and AIG, Fannie Mae, Royal Bank of Scotland, HBOS and others were on the verge of collapse. Western leaders sank trillions of dollars into the system to prevent the World Bank system from collapsing. Years later, the effect of the banking collapse is still felt. The earliest cryptocurrency promoters hinged on the fact that banks had failed and the world needed an alternative currency that was not subject to government control. Whether they achieved their major aim of having a currency free from unnecessary control and fluctuation is yours to decide. Keep watching to see how things unfold. In 2009, a man under the pseudonym Satoshi Nakamoto took a bold move to mine the first Bitcoin. Over the years, many stepped forward, claiming to be the real Satoshi, but none had sufficient evidence to prove it. In the first 7 months of its launch, Satoshi reportedly mined about 1.1 million Bitcoins. Between January 2009, when it was launched, and August of that year, Bitcoin was worth over $22 billion. Joshua Peck, the founder of cryptocurrency hedge fund TrueCode Capital, said earliest Bitcoin investors were fascinated about the design, although they didn't know what it was and how it was supposed to work. It was a fairly new idea with chances to survive, so many gave it a shot. The first real Bitcoin transaction occurred on May 22, 2010, when a Florida man agreed to pay 10,000 Bitcoins for 2 pizzas priced at $25. He must have regretted undervaluing the currency, considering how fast it grew in the later years. However, that's not the point. The first transaction gave Bitcoin prominence and value. To this day, the Bitcoin community celebrates Pizza Day on May 22nd annually. With time, more people understood the currency's supposed financial value and was broadly understood, until it became the cornerstone the earliest investor builders rejected. Bitcoin was not available to buy, sell or trade until 2010. By 2011, it reached the $1 threshold. Years later, similar digital currencies with the same blockchain mechanisms became Bitcoin's competitor. Litecoin was the closest, followed by Ethereum. In November 2013, Bitcoin prices reached $1,000 and grew steadily until it reached $20,000 in December 2017. Note how the increase in value seems too good to be true. Therefore, skeptics were confident that price falls would be as drastic as the prices went up. They were not wrong after all. As the cryptocurrency craze increased, some critics watched from a distance and warned of impending doom. Jarek Hierniak, the founder and CEO of Generation Lambda, said Bitcoin was similar to an innovation trajectory called the Gartner hype cycle. The model states that when a new technology, in this case crypto, gains visibility, expectations rise to an unreasonably high level. At first, most people ignore it, but then it gets everyone excited. Soon, they realise that the new technology cannot keep up with its promises. He goes ahead to warn that such a situation and lack of liquidity, combined with little regulation, made it ripe for manipulation. In 2017, the hype and excitement in the crypto market created room for an asset bubble. Many startups used the currency to raise money via initial coin offerings called ICOs. Between 2017 and 2018, over 800 ICOs raised about $20 billion in funding. Unfortunately, ICOs were plagued with wanton scams and fraud, causing their value to collapse within 1 year. By the end of 2018, Bitcoin prices crashed to $4,000. Mind you, it moved from $20,000 to $4,000 within a year. Satoshi had claimed that the cryptocurrencies would fare better with price fluctuations since they were not regulated by any government, but by a peer-to-peer arrangement. This may have worked in its earliest days, but I cannot say the same today. Investors have lost billions of dollars to this digital currency, a disaster that would have been avoided in notable fiat currencies. The scams, price fluctuations, scandals, and anonymity are why some analysts think it's the greatest scam in the world. Hold on, it's not time to sell your cryptocurrencies yet. Satoshi may have gotten into your head and convinced you to invest in a sham he knows will not stand the test of time. Why do I think so? Let's get right into it. Just as Satoshi didn't want to be known by his real name, he also wanted to keep the government and its agencies from tracing how money is exchanged in the blockchain. Many investors love the idea of trading freely without probe or investigation. After the 2008 white paper introduced the first cryptocurrency, it claimed that all transactions were privately and completely anonymous. Yes, we agree that it's anonymous to a great deal, but it's still subject to investigation when something goes amiss. In 2022, the authorities in Manhattan seized $3.6 billion worth of Bitcoin from a Manhattan couple. They arrested and charged them with money laundering in connection with a 2016 hack on the Hong Kong cryptocurrency exchange Bitfinex. How did they hack into the system, and how did the government trace them? Well, keep watching. Law enforcement agencies traced the illicit funds through a complicated web of transactions across multiple countries. It took 6 years to trace it, but they eventually exposed the couple. It's better to argue that Bitcoin transactions are difficult to trace rather than misinforming the public that they are untraceable. Researchers have demonstrated traceability through unintentional patterns in Bitcoin's data. They say that the bigger a dataset gets, the more patterns appear. These patterns can be identified and tracked. During the earliest days of Bitcoin, law enforcement agencies were still getting used to the technology. Therefore, they didn't have enough resources to trace illegal payments. With time, the authorities mastered the art of fishing out oddities in the system. Cryptocurrency transactions are recorded on a public blockchain. These trades are not linked to an identity, thus confusing this with anonymity. Here's where it gets dicey. While there are some products or services one can buy directly using Bitcoin, there are others you must exchange in local currency to spend. And guess what? Converting Bitcoin to a fiat currency like the US dollar creates a trail. This is the point where you make the job easier for law enforcement agencies to investigate. You need a cryptocurrency exchange service or participating banks. These companies operate on a Know Your Customer basis, popularly called KYC, meaning they verify your identity. Gordon, a financial expert, noted that, regardless of how anonymous or pseudo-anonymous Bitcoin is, the services that transfer Bitcoin into dollars are not anonymous, and so therefore, transacting it would not be anonymous in any meaningful sense. Trading cryptocurrency with the notion that it's 100% anonymous is not only misleading, but disastrous. This investment is high risk, meaning that anything can happen. Insurance companies do not insure cryptocurrencies, so be prepared for the consequences of your decision. Scammers capitalize on the relative anonymity of cryptocurrencies to rip people off their money. Let's see how this works in the present day. After cryptocurrencies became popular, scam artists were excited because they could now port to the system and become more sophisticated. These swindlers use various means to lure victims into fraudulent crypto investments or enter fake relationships via dating apps. A recent report by the Federal Trade Commission shows that crypto romance scammers conned their victims $139 million in 2022. The Commission also noted that about 46,000 consumers lost over $1 billion in crypto between January 1st, 2021 and March 31st, 2022. This is the number of reported cases though. There could be thousands of others that chose not to report. Aaron Cohn, a partner at a firm focused on financial fraud, said his practice had seen a rise in victims seeking help with hacked crypto accounts. It's hard to believe that paper monies are relatively safer than digital currencies lately. Like every other financial scam, crypto scams target your crypto assets. These scammers lure investors into purchasing an asset with fake claims about its value. Better still, they're out to steal digital assets. Crypto scams take many forms, most of which are too good to be true. One such scam is the investment scam, where an actor entices an investor to send their cryptocurrency to the fraudster with promises of huge gains. These scammers are sometimes disguised as celebrities, investment managers, or lovers on a dating site. Whatever role they assume, they promise their victims to grow their investment. Better still, they sell an obscure cryptocurrency to you at an incredibly low rate with promises that it will rise in value. You can guess what happens when you fall into that trap. Lately, we've seen the proliferation of new digital currencies and how they are marketed to investors. These investors are made to believe they can earn a triple-digit percentage over a short period if they invest in the new currency. The prospect of excessive profit lures them into the fake investment and slips them into depression afterward. Aside from investment scams, one could fall victim to upgrade scams, phishing, fake crypto exchanges, SIM swap scams, etc. The question of cryptocurrency safety will remain a contentious issue for many years. The currency is volatile, and the lack of regulation means that investors share the same financial ecosystem with scammers. There's no agency to eject them out of the system. Investors depend on luck for survival because you can never differentiate the real from the fake. Aside from the risk of losing millions to fraudsters, the blockchain world is laced with infamous scandals. One would have thought it would be enough to dissuade newcomers, but it merely scratches the surface. Despite digital currencies' hype, they have not been without highs and lows. Hardly a famous investment like this goes without setbacks. Since the launch of the first Bitcoin in 2009, it's been from one scandal to another. In all scandals, huge monies are lost, but no one is apprehended. Do you still want to have your money stolen and never recovered? Let's see how Mt. Gox pulled through with this one. What is Mt. Gox and how did it collapse? Mt. Gox was a Tokyo-based cryptocurrency exchange that operated between 2010 and 2014. During its heydays, it was responsible for over 70% of Bitcoin. Ironically, it declared bankruptcy in 2014 and remained the subject of speculation and lawsuits for years. Jed McCaleb created the Mt. Gox website to allow enthusiasts of the Magic game to trade cards online. The site was later transferred to Mark Kapelis in 2011, who became the CEO. It became so popular that it suspended trading in 2013 for a few days to cool down the market. Due to its prominence in the cryptocurrency market, it became a target for hackers. While it struggled to survive several hacking attempts, it reached a climax in 2014. At the time, customers expressed concerns about the increasing difficulty they experienced with withdrawing funds. The company claimed the issue was caused by a bug in the software, a claim that was later disputed in the wake of 2021. It was already too late when the company realised that the software had been tampered with. Hackers had made away with $650,000 to $850,000, nearly $460 million. It managed to recover $200,000, but this was a drop in the ocean, which meant thousands of bitcoins went missing without a trace. In April 2014, it filed for bankruptcy in Tokyo District Court, and was liquidated that same month. Investors hoped that, somehow, the authorities would apprehend the Russian hackers behind the heist. By then, all fingers pointed that way. This hope motivated CoinLab, a leading creditor, to pursue its multi-billion-dollar breach of contract lawsuit against Mt. Gox. Recall that these investments are without insurance, so if it's lost, that's the end. Fiat currencies fare better in cases of theft and fraud. The US Federal Insurance Deposit Corporation, or FDIC, protects banks from up to $250,000 in losses. Similar agencies exist in every country. Unfortunately, cryptocurrency investors do not enjoy this privilege, and they know this. Incidents like the Mt. Gox scandal motivated exchanges like Coinbase and Binance to come into the picture. These companies claim to protect investors of digital funds from theft, but then they require your details like password and name to join. This takes us back to the issue of anonymity. Isn't it ironic that a supposed anonymous currency needs your details to protect you from fraud? How is it different from the paper money many have come to abhor? In 2018, Binance established the Secured Asset Fund for users to protect their funds. It committed a portion of people's savings to the fund, but in 2019, Binance lost $40 million in a hack. The company claimed it didn't affect investors because Seifu paid for the losses. Even if we agree, it still takes us back to how porous the system is. The crypto market is a topsy-turvy investment because it experiences huge fluctuations in value. Since there are no regulations, investors are forced to live with this reality. You will likely get two different responses if you approach two crypto investors to discuss their experience with the currency. One may have made thousands of dollars in profit, while the other recorded huge losses. The loser didn't lose because he made bad financial decisions, but was just unlucky. The value of a cryptocurrency can drop by 30% in one day and rise by 70% the next day. Why is it so? The simple answer is that it's not valuable. It is not like diamond, gold, or any tangible asset. Because it does not have a backbone, it rises and falls depending on its mood. Crypto enthusiasts do not agree. They say it's valuable, but it depends on people's willingness to trade for it. Most people invest not because they want to trade with it or use it as currency, they only need it because it serves as a hedge against inflation. Crypto's value is based on speculation rather than logic. This is unlike paper money, where governments are deliberate about economic policies to improve the currency's value. Imagine a famous investor withdrawing all their bitcoins for fear that the value will fall. This breeds fear in the minds of others who will likely agree with this. In 2021, when Elon Musk announced that he had fallen out of love with Bitcoin and would withdraw about 75% of his holdings, the price fell by 3.6%. Although it rose shortly after the announcement, it remained in the red. Tesla invested $1.5 billion in Bitcoin banking on the currency's assumed long-term potential. Months later, it converted most of its coins into fiat currency. In the first quarter of 2021, Tesla's market value was $2.48 billion, but as of when the company withdrew it, it dropped to $2 billion. The second quarter of 2021 saw the currency at $46,000, but by the end, it fell to below $19,000. In response to this drastic move, Musk responded, "The reason we sold a bunch of our Bitcoin holdings was that we were uncertain when the COVID lockdowns in China would alleviate, so it was important for us to maximize our cash position." He added, "This should not be taken as some verdict on Bitcoin." Musk went ahead to call Bitcoin a sideshow to a sideshow, meaning it shouldn't take center stage in major financial decisions. Investing in speculative assets is similar to a hot air balloon ride, where you can enjoy the ride from the top and wish you could get out without falling. With cryptocurrencies, what goes up comes down. This video does not encourage or discourage you from investing in cryptocurrencies. It only lays bare the bitter truth not many people are willing to admit. If you're prepared for a bumpy ride, try this. Imagine gaining 50% of your present net worth in a single day. How about losing nearly 70% of it in the same breath? If you think this is not a worthy risk, it's best to back out. With all that is happening in the cryptocurrency industry, there's hardly a one-size-fits-all approach that solves the problem. Governments of many countries have taken steps to protect their citizens' investments, but it doesn't work. Other governments have taken their hands off and left investors at the mercy of their decisions. Governments cannot regulate digital currencies even if they try, and here's why. Despite being around for over a decade, governments of the world cannot predict how these currencies will develop. Their inability to understand the protocol and its implications can lead the authorities to make irrational decisions that will hurt the economy. Although the Russian government outrightly banned the use of Bitcoin and other digital currencies to protect its citizens from terrorism and money laundering, they cannot enforce it. These currencies are decentralized and based on peer-to-peer systems. There is no one to catch and no central server to shut down. Would the Russian government stop citizens from downloading apps on their phones? Governments are scared that the digital currency industry creates a breeding ground for illegality and illegal organizations, but their hands are tied. Cryptocurrencies are inextricably tied to the deep web. Take the story of the Silk Road, for instance. This anonymous marketplace allowed anyone to purchase anything with Bitcoin. The deep web is a massive breeding ground for criminals. Unfortunately, outlawing Bitcoin does not halt the activities on this web. Even if the government successfully outlaws Bitcoin, which is impossible, many other anonymous currencies will replace it. Where does the development of anonymous currencies occur? Russia, the only country that outlawed all cryptocurrencies, is home to all kinds of anonymous digital currencies. Another possible way governments have tried to control cryptocurrencies is by banning tumblers. Tumblers are tools that help users confuse the source of their bitcoins. Unfortunately, the government hates to admit that it has no authority over cryptocurrencies. The cryptocurrency ecosystem is evolving faster than government regulations can keep up. They do not understand its current form and what will become of it tomorrow. This deviation from the norm requires a more flexible and broader approach from the government. Better still, people should be left alone to manage their risks themselves. Cryptocurrencies are whatever you make out of them. From partial anonymity to the lack of government regulations and the proliferation of scammers on the system, it's a no-brainer that crypto is the greatest scam in the world. Holders of these coins know it's a 50-50 game. Please tell us in the comment section if you have lost or gained from this speculative investment, and how best you think investors can protect their money. Like and subscribe to this channel as more juicy content is coming our way.